economy and the real estate market. I mean, how the heck are these two related? I mean, we're flooded with news stories and headlines on the daily saying things like inflation is cooling off, jobs reports come out better than expected, or you gotta love this one, consumer debt has hit an all-time high. Well, believe it or not, all of this economic data has a big impact on our housing market. As a lender of 20 plus years and someone who studied finance and economics in college and now spends hours every day following the data, I want to share some insights on some of the big data points that indicate how well or poorly the economy is performing, how they affect the housing market, and then why it's important for you to know. But before we get started on this Econ 101, if you wouldn't mind giving this video a thumbs up and subscribing to my channel, it would really mean a lot to me. And it also helps us reach more people and continue our journey to helping you build wealth through real estate. Everyone pays attention to when the Fed makes a move. But what economic data are they looking at? I want to dive into the Fed rate, but also inflation, job numbers, consumer confidence, and retail sales. And this is just the tip of the iceberg when it comes to the economics. However, understanding how these are related will start to put the economy more into a real estate perspective. So let's start our deep dive with the Fed rate, as I think it's important to note that the Fed rate does not impact mortgage rates, but in fact impacts short-term rates like HELOCs or home equity lines of credit, credit card debt, consumer loans, and business loans. When the Fed lowers or raises the Fed rate, mortgage rates do not necessarily move. What does, however, move mortgage rates is how the market or investors perceive the Fed actions. I mean, an excellent example of this is when Fed Chair Powell announced that he was expecting to drop the Fed rate 3 times in 2024. The market got so excited that they heard the Fed was dropping their rate 6 times and as early as March. Not at all what Powell said, but it sent mortgage rates dropping more than 0.5% in a singular day. That's huge. The Federal Reserve has 2 mandates: keeping the price of things Americans buy stable, i.e. controlling inflation, and maintaining an economy that provides jobs for all who want one. It's important to remember these 2 mandates because it dictates what kind of reports are most important to the Federal Reserve. So let's take each one of those 2 mandates separately: inflation, then jobs. Inflation is reported one of 2 ways: either through the CPI report, which is the Consumer Price Index, or the PCE report, which is the Personal Consumption Expenditures Index. The CPI measures things that you and I pay for, like a gallon of gas or rent or milk and eggs. The PCE measures things that change in goods and services consumed by all households. Each one of these reports is then broken down even further to either the headline report or the core report. The headline data is all the inflation data. The biggest difference between the two is that the core strips out the volatile food and energy prices. This is important because the Fed looks specifically at core, and even more specifically at PCE core. The reason that they've identified the PCE core is that the Fed wants to measure only things that they can personally have an impact on. So if there are major geopolitical or weather-related impacts to the cost of things like gas or eggs or wheat, that cost is stripped out. When these inflationary numbers are high, it erodes the purchasing power of consumers and affects consumers' ability to spend and save. It also often leads to rising mortgage rates as lenders seek to compensate for the eroding purchasing power of money. These higher rates reduce housing affordability and potentially reduce buying demand in our housing market. So let's jump over to the second mandate: jobs for everyone who wants one. Jobs data is usually a good indicator of the overall economy. A strong labor market occurs during times of financial and economic strength. higher wages, low unemployment, more job openings, and higher quits are all reports and indicators of a tight labor market where employers are looking for employees and employees have a greater negotiating power. This confidence of workers can lead to greater spending and more demand on the economy's resources, pushing or holding inflation higher and rates higher. When looking at the overall labor market, some of my go-to reports are the monthly jobs report and the unemployment report. The Bureau of Labor Statistics, or BLS, will publish their measure of new jobs created by industry every first Friday of the month for data of the previous month. Now, based on jobs created compared to either the market's estimates or the previous month is how the market interprets this data as being either good or bad. Now remember, strong job creation points to stronger economy. Strong economies typically have higher interest rates. The sister report to the jobs report is the unemployment report. This report measures the percentage of people in the labor force who are without a job and actively seeking employment. Actively seeking employment is key. I mean, if people have given up, they're no longer counted. So it's the number of actively seeking unemployed persons divided by the total labor force. Low unemployment rates, like currently 3.7%, are a positive sign as they suggest economic stability and a strong labor market as people have jobs. It also results in stable or rising mortgage rates because it indicates a healthy job market. A strong job market can drive demand for housing as people are more confident about their employment prospects. But it can pinch affordability with the higher rates that come with it. You don't have to wait for the monthly reports to see the job trends. Every week, there's a more timely initial jobless claims report that tells you how many people filed for unemployment that week. Now remember, a person can file for unemployment, then find a job, then file again later. Every time they go back on unemployment, they are counted as an initial jobless claim. High initial jobless claims can indicate economic instability or recent challenges in the labor market, creating uncertainty in the market and potentially lower mortgage rates as investors seek safer assets. Lower initial jobless claims have the opposite effect. Now, let's look at the economy from a consumer perspective. So we've moved away from the Fed, and now we're talking about how Americans feel. And when they feel good, they want to buy things. They want to experience things. They want to travel and they want to eat out. While inflation and jobs tell us a lot about the economy, so do the habits of the consumer. Reports I watch on a regular basis to get a feel for how the consumer is feeling is the consumer sentiment, the consumer confidence, retail sales, and consumer spending reports. I look at savings rates too, but more for a possible end to spending, not necessarily a measure of their confidence. So let's define each one of these reports quickly. Consumer confidence is released monthly by the Conference Board. It focuses more on the job market and job security. Consumer sentiment is released monthly as well by the University of Michigan. It focuses more on personal finances and people's pocketbook health. These two surveys, even though they cover the same month's data, are taken at different times. So big moves in the economy, like a surge of gasoline prices, can make one report turn out very different than another. These two reports are typically looked at as a comparison metric, meaning, are consumers feeling better than last month or last year? And if so, by how much? When we see big jumps in confidence, we know Americans are feeling wealthy from things like a strong stock market, secure jobs, or the price of goods coming down. This confidence is usually a leading indicator of consumer spending and can also lead to rising mortgage rates as optimistic consumers drive economic growth. For the housing market, it's a mixed bag. I mean, optimistic consumers are more likely to invest in homes, potentially boosting demand and pushing prices up. Increased demand can keep inflation up as demand for everything is higher in strong economies, which regretfully affects mortgage rates. Higher prices and higher rates can hurt affordability. Consumer spending and retail sales is the outward measure of consumer confidence. Retail sales refers to the total amount of money spent by consumers on goods and services in a specific period of time. Consumer spending is spending on a wider range of products and services. Strong retail sales indicate a healthy economy, as consumer spending is 2/3 of our nation's gross domestic product, or a measure of our economic output. And as we know by now, a strong economic growth has the potential for rising mortgage rates. So while stable or increasing rates might be a downside, a robust economy can boost housing demand, as people may have more confidence and resources to invest in homes. So the bottom line is headline and core inflation impact mortgage rates and affordability. Unemployment and initial jobless claims reflect job market health. Consumer sentiment can drive consumer spending and housing demand. And retail sales reflect the overall health of the economy. It's important to note that while the housing market is also impacted by so many other factors like weather or natural disasters, local governance, new build supply, or school district changes, the economy is just one, but a very important factor in our housing supply and demand. And a basic understanding of this data and how it's all connected can help you make a more informed decision for you, your family, and your financial situation. Well, that was a lot. I know it was. It was just the tip of the iceberg. If you have questions, don't hesitate to leave them in the comments below. I take the time to thoughtfully answer any questions and comments. And if buying a home is on your to-do list for 2024, let's schedule a time with my team right now. Let's get you pre-approved and confident in your options and next steps. If you have not subscribed to my YouTube channel yet, make sure to do that as well, as we are creating great content on building wealth in today's real estate market.